I think all eyes right now should be on silver. There's about 250 million ounces outstanding for the July expiration with only 3 days left. And 250 million ounces, I mean, the world only produces 850 million ounces total production for the year. So you're looking at what, 30% of global production may be standing for delivery. Yeah, we're absolutely still in a bull market. I mean, the bull market's intact from a technical standpoint, as long as it holds. I guess the number would be what, 2,800. That would be a 20% retracement, which would be a bear market, which would break the bull market. I think all eyes right now should be on silver. There's about 250 million ounces outstanding for the July expiration with only 3 days left. And 250 million ounces, I mean, the world only produces 850 million ounces total production for the year. So you're looking at what, 30% of global production may be standing for delivery 3 days from now. Well, if you leave the chart where it is right there, that is almost a perfect inverted head and shoulders, which tells you, I mean, if you look at the breakout itself, we actually got down to, I think, about 35.10, 35.20 this morning. So, that's a probe of the breakout level. We may, it may take a little bit of time to chop and hold this 35 level before it goes higher. And like I said, 3 days from now, I mean, that could be a huge fundamental event where you've got, like I said, 250 million ounces could stand for delivery. There's no 250 million ounces anywhere in the world to deliver. I've said all along that I thought silver would be the detonator to gold, and gold will literally destroy all derivatives. I mean, once there's a failure to deliver, all derivatives are going to fail because everything runs on confidence, and it would show that, you've got a failed contract. What's the value of a contract that cannot perform? The answer is zero. So what you're saying there is paper's worth zero, and thus what is the real thing worth? The answer is there's no telling what the number is going to be, but it's going to be, when all is said and done, many multiples of where pricing is right now. Yeah, there's no issue for institutional entities as far as storage is concerned. I mean, they can find the storage space. And you're speaking right now of the investment demand. Mm-hmm. And silver is different than gold. Gold is basically all investment or monetary demand. Silver's got so many different uses. Silver's got medicinal uses. It has industrial uses. It has technological uses. Every time you see a Tomahawk missile launched, there goes a monster box. I mean, there's over 500 ounces per Tomahawk missile. So silver, you've got to look at a little differently because there's not just investment demand. That's not the primary demand. The primary demand for silver is, as I said, medicinal, technological, industrial, etc. Even if we just got back to, and you might want to put your cursor up to the 40 to 50 level.
Okay.
What that would do, I mean, if we got to 40 or we got to 50, what you're talking about is silver will outperform gold 2-to-1 as far as purchasing power. So what I'm getting at is the risk reward of owning silver right now is hilariously in your favor. Well, yeah, there's absolutely upside potential in the gold price. I mean, just do the math on the amount of gold that the U.S. says they have versus the amount of debt outstanding. And when I say debt outstanding, I'm just talking about on-books debt. Mm-hmm. I'm not talking about Fannie Mae, Freddie Mac, Ginnie Mae, all the loan guarantees, Medicaid, Medicare, all the guarantees, you're over $200 trillion. But if you just use the 37 trillion divided by 8,400 tons, the number you're looking at, if we had to pay our debt off in gold, we would have to price gold at about $135,000 an ounce. So there's tremendous upside to gold, but there's, in my mind, at least double the upside in silver versus gold. So, I mean, this term was coined years ago, but silver is going to be gold on steroids. I mean, on any given morning, you could wake up and gold's up $100, $200, never to look back. I mean, if we woke up one morning and found out that a tanker or a couple tankers hit mines in the Strait of Hormuz, what's that going to do?
Right.
That will break confidence. And God forbid should we wake up one morning and find out that a aircraft carrier got sunk.
Mm-hmm.
I mean, that would be a disaster, because in the past, the dollar has always been the safe haven for foreign monies. What happened, if something happens that breaks confidence and the dollar/treasuries are no longer viewed as the safe haven, you're looking at game over USA.
Yeah.
And Danny, the reason it's game over USA is, what are we hearing now? That the next 4 years, the debt is going to increase by 10 trillion. That's a disaster. And what that means is we need to borrow 10 trillion just to keep the doors open, just because of the level that it started from. Silver was slightly oil was slightly oversold, and gold is, slightly overbought and deserves a break. I mean, to see a pullback to 3,000, 3,100, that should not raise any eyebrows whatsoever. I mean, it would just be a relaxing of that market and working the overbought off. So I just view it, the percentage moves, oil should go higher on a percentage basis just because it was not overbought to begin with. Yeah, and that's a new low today on the dollar. 97.30, 97.40. That is a new low on this whole move for the dollar. So the dollar has not gotten a bid. And if you look with that chart right there, you see that how many years is that? 1, 2,
3.
Almost 3 years. You can see the bottoms in that sequence. At bottom we get a bounce, at bottoms and we get a bounce. This time we've broken through that support, and it tells me, you've got downside to find another support level from here. In today's world, as I just mentioned, you wake up one morning to a disastrous fundamental event, and you could see the dollar quickly in the 80s. Well, you've got some foreign flow from a fear standpoint. But I think rather than looking at the noise right now in that market, I think it's important to understand that the last big event was the Federal Reserve cut once or twice or 3 times. They cut a full 1 percentage point. But if you make that chart go back further, you'll see that from where the Fed started cutting rates, interest rates on the 10-year Treasury, or across the board really on the yield curve, are up 1 full percentage point. So the Fed cut rates 1% and market rates went up 1%. That suggests to me that the Federal Reserve is losing control of the yield curve. I think they'll try anything and everything. And I think they understand that they've lost control. The problem with losing control is, and I mean, Trump has said it himself, he wants rates lower so that the amount of interest paid on the debt is lower. But what if Mother Nature actually does take charge and there all of a sudden is some risk premia to the yield, and yields are a point, 2 points higher than they are now. How does the government keep the financial doors open if they can't borrow? I don't think so. I think it's the cake is already baked and it's about to catch fire in the oven.